Review video for the chapter on insurance in Junior Cycle Business. So, what is insurance? Insurance offers protection against possible loss and tries to put the insured person back in the same financial position they were in before the loss occurred. You're not going to be better off following an insurance claim, but hopefully you're not going to be worse off either. You're just going to be in the same financial position. So the way it works is you have an insurance company which gathers together a large amount of premiums from thousands of customers. They put that money into an insurance fund, and from that fund, they pay out compensation to the unfortunate few who have an accident, and then they will pay out running costs as well because they'll have their own wages and electricity and heating and all that, and then what's left will be profit for the insurance company. So compensation, the word compensation is financial payment made to an insurance company if they suffer a loss, and that loss is insured against. The cost of insurance is called a premium. So the premium is the amount of money that is paid by the insurance company in return for providing insurance cover for that particular risk. Now, there are five basic principles or rules of insurance that we need to be familiar with. Insurable interest, utmost good faith, indemnity, um, subrogation, and contribution. We're just going to remind you of all these five now. So insurable interest means to insure something, you must benefit from its existence and you must suffer financially from its loss. You cannot insure somebody else's property. You can only insure something that you own yourself and you benefit from its existence. So I cannot insure my neighbor's car because I do not benefit from its existence, nor do I suffer from its loss, but I can insure my own car. Utmost good faith. This states that you must answer all questions truthfully and reveal all relevant information or material facts, we call them in insurance, when completing a proposal form or claim form. So if you're filling out a form looking to take out car insurance, you cannot pretend to forget or ignore the fact that you've had a conviction for dangerous driving last year. On the form, it'll say, do you have any driving convictions? If you tick no to that, when actually you've been done last year for dangerous driving, well, then your insurance will be null and void when that comes to light. So you must declare all relevant facts. A material fact is anything which is likely to change the decision to grant insurance. When you're taking out health insurance or when you're taking out life insurance, if you have a pre-existing health condition, that's a material fact. The insurance company has to be told about that. The principle of indemnity. That means the insured person cannot make a profit out of insurance. Insurance exists to put the insured person back in the same financial position as they were before the loss, not a better one. So you cannot crash your car worth €10,000 and then get 20,000 back from insurance and be better off, twice as well off. And that cannot happen with indemnity. Subrogation. This is once an insurance company has paid compensation for any insured item, then the right of ownership of that item passes to the insurance company. That's an important and a complicated enough one. But let's say, for example, if your car is stolen and you claim on your insurance. So the insurance company give you €15,000 compensation for your car, and you go off and you have your money. You don't have a car anymore, but at least you have the 15,000 to buy a new one. Now, let's say 3 weeks later, your car is found by the police, by the guards, and it's undamaged and it is in perfect working order. It's just been left abandoned by the criminals. Well, you cannot get back that car because the legal right of that car has passed from you to the insurance company once they paid you the 15,000 compensation. If you if you want, you can take the car back, but you'll have to give them back the 15 grand. You can't have the money and the car. that's defeating the principle of subrogation. So an insurance write-off means that the cost of repairing the damaged item is larger than the replacement value. That's what it means to write something off under insurance if a car has been so damaged that it is not worth fixing. The fifth principle, of insurance here is contribution. And that means where the same risk is insured by more than one insurer, they will divide the cost of the claim between them. So if you insure your car with two insurance companies for €10,000, FBD and Aviva insurance. Well, if you crash your car, you will get not 10,000 from each because that would make you better off than you previously were. You would get 5,000 from FBD and 5,000 from Aviva, making it up to the 10. So therefore, it's kind of a pointless activity because you had to pay out two premiums, and yet you're only getting the same compensation. That prevents people from doing it. Different types of household and personal insurance. I'm just going to rattle through these quite quickly because we just need to know what they are. Of course, the first one is motor insurance. It is compulsory in Ireland. It means you have to have, by law, third-party motor insurance. And that's a criminal offence to drive without that. So that's the top one here. Third-party insurance covers injury to another person or damage to another person's car or property by the insured driver. It does not cover the policyholder or their own vehicle. So if I have third-party insurance and I get into a crash with somebody else on the road, let's say I was at fault, well, my third-party insurance, which I must have or else I wouldn't be driving, my third-party insurance will cover that other person's car because it was my fault. And it might cover their own personal injury, but it will not cover my car. My car I have to fix at my own cost. However, if I like my car, I might like to get slightly better insurance. I might get third-party fire and theft, which covers the third party and also if the vehicle catches fire or is stolen. Or if I really like my car and I really hope that even if I do crash it, I'm going to get it fixed, well, then you pay for comprehensive insurance. And this benefits all parties and vehicles that suffer, including my own car, the insured person's vehicle. Now, this type of insurance is more expensive, obviously, because they're going to fix my car and the innocent third party's car as well in the event of a crash. So the first party is the person who takes out insurance. The second party is the insurance company. And then where the name comes from, third party insurance is any innocent person or item which suffers a loss caused by the first party, the innocent person that you drive into. A no claims bonus is a discount off your insurance premium, and it rewards the insured party for not making any claims on the policy. I have a 50% no claims bonus because I haven't made a claim in the last 5 years. In fact, I've never, touch wood, made a claim on my insurance. So therefore, that reduces my premium by 50%. It's worth a lot of money to me. A loading is an extra amount added on to the basic premium to cover extra risk. The insurance companies will add on a loading if a driver is on a provisional license, if they haven't passed their test, if they have penalty points, or if they have a driving conviction, then a loading will be added on, and they'll have to pay much more for their insurance. Stepping away from motor insurance, buildings insurance, of course, covers damage to a building in the event of fire or flood or storm or accidental damage, like a tree falling. It'll provide compensation if the structure is damaged of the building. But then there's also contents cover, and that covers the contents of the house from accidental damage, fire, flood, burst pipes, and also theft. So if somebody breaks in and steals your technology, your TV, or your laptop, that will also be covered under your contents insurance. Personal accident insurance, if somebody has a fall or breaks a tooth or something like that, then that will cover them in that regard. Health insurance covers your medical bills and the cost of your hospital care. in the event of you getting ill. Critical illness cover will pay out a tax-free lump sum if you get a serious illness or disability, and there's a whole big long list of them. These are all optional insurances. The only compulsory one is the motor vehicle third party. So some people take out lots of insurance, other people don't do so. Travel insurance, if something unfortunate happens to the insured person while they're traveling, perhaps a flight is cancelled and they have to stay an extra amount of time, perhaps they lose their luggage, perhaps they're mugged or something stolen on them. Mortgage protection insurance, in the event of the death of an insured person during the mortgage repayment term, this type of insurance will repay the mortgage for them. So it's like life assurance when you have a mortgage. Payment protection insurance, if you lose your job, then these will pay off your loans for a certain amount of time, including perhaps your mortgage. Salary protection insurance, again, if you lose your job or if you're injured and unable to work, this insurance will pay some of your wages. Mobile phone insurance, if your phone is damaged or stolen, it will cover it. Pay-related social insurance is also a compulsory insurance. By law, all employees must pay PRSI. And of course, sometimes people consider this like a tax. It's actually a form of social insurance. But then if you were to lose your job, you might get illness, disability, maternity, or job seekers benefit. So it entitles you to those social welfare payments from the government. Life assurance will pay out when a person dies. So therefore it's called assurance, not because you are assured that somebody will die at some stage. There are different types of life assurance cover. Whole life pays out on the death of the insured person. Doesn't matter what age they are, when they die, their family get the money. Term policy is for a fixed period of time, so you'll take out life assurance during your 25 years or 30 years of your mortgage. And if you die during that period, then your mortgage will be paid off. Beyond that, the life assurance is cancelled. An endowment insurance pays out a guaranteed amount either on a specific date, like your 65th birthday, or sooner if somebody dies. So it's whether you reach a certain date or if you die, you get endowment policy paid out. Paid to your family or paid to you, depending on the circumstances. Some jobs in the insurance industry. So a broker is somebody who sells insurance and gets the best fit for individuals for their insurance needs. An agent also sells insurance, but only for one insurance company, whereas the broker finds the best value in the market from any insurance company. An actuary is the person in the insurance company who decides on the premium, does all the calculations, and a loss adjuster is the person who comes out to view the accident and will calculate how much compensation has to be paid. When you take out insurance, you have to complete a proposal form. A proposal form is an application form for insurance. An excess amount is a little amount that the insured person must pay first, and then the insurance company will pay the rest, often maybe €200. A claim form then is the form you fill out if you have to make a claim, if you've actually had an accident. Average clause is where if you only have partial or underinsurance, then you will only get partial or half, whatever it might be, the compensation. So if you only insure your home for half of its value, you will only get half compensation. If you insure it for 2/3 of its value, you'll get 2/3 of compensation. So underinsurance is if it has not been insured for its full value, then the principle of average clause will apply. To renew a policy, the insurance company will send you out a reminder every year, and you should always shop around to make sure that you can get the best possible deal each year. The benefits of insurance are that you can replace or repair damaged items, and it will protect you from big uncertainty of loss, and it'll help you with your household income for salary or critical illness cover. And perhaps it's definitely required by law for motor vehicles, The rest of it is kind of up to yourself.